Hi, it's Michael Douville, and I am so pleased I have Charles Nenner with me today. It's April 6, 2021. It's been 6 months since the last time Charles and I chatted. And before we get going, because we have some slides that you sent us, and we're going to go through the slides, this is going to be very, very fun. I personally want to thank you for some of your advice. Honestly, you know, you and I have such a remarkable clientele. My clientele is baby boomers. You know, I'm in the real estate asset class, and they're so concerned about their income streams. You know, when you start to retire, you're living on your income. You know, you're no longer working, so you really need that income. And they were getting it out of bonds. And of course, and you had mentioned, you know, you and I have been talking about this for 3 or 4 years, talking about real estate, but not general real estate. We've been talking about small units and entry level. And of course, that's really my wheelhouse. We're here in Arizona. We have a lot of entry level, and lots of people want to rent them. It's just a great rental, but it's been so good for my clients. But a lot of them also use bonds for their income streams. And when we talked in October, you gave a warning that bonds were really at the end of the cycle, because it's a pretty long cycle, and very long. Yeah. So how long is this? Is it 35 years or 75?
Yeah, that's usually from bottom to top, about 35 to 38 years.
38 years would be almost perfect. 38 years, you know, because you can really see when Volcker did that in 81, can't you? I mean, there's no missing that cycle. You know, when
you know my opinion, he didn't do anything.
No, I know.
Moment.
I know, but it just stands out. I mean, there's no missing that wave. But your advice allowed my clients to reduce their exposure to bonds. And of course, since then, I think you and I were chatting in the pre-interview, like TLT, which is the long bond ETF, that's dropped 17% since October. That's a really significant drop. And of course, you're not getting any income, and you lose 17% on your portfolio. That's pretty significant, particularly for like a baby boomer, because we're really risk averse. You can't get that back. So thank you, Charles. That was just really, really terrific advice. So what are you seeing in the world that you want to bring up? We'll take a look at your charts, but anything that you'd like to mention?
Well, the charts say most of it, because we got something about the Dow Jones, the stock market, about gold, about the bonds, because, you know, people who didn't go out, let's see if they can have a bounce, a second chance. They don't get back what they lost, but, you know, they have to know when to sell. Maybe, you know, based on my cycle work, which we show on the charts in a minute, we can help them to give a second chance. So we'll see what's going on in the markets. We got 4 or 5 charts, and that covers actually everything that's going on.
Right. Well, you know, what helped us too was that when you said to get out of the bonds, it meant you shouldn't be lending money anymore to governments. But we took it conversely and said, well, if we shouldn't be lending money, maybe we should be borrowing. And a lot of my clients, we took really long-term mortgages at rock bottom prices. And thank you for that. It was just absolutely terrific. You were outstanding. So how about if I roll over to the charts? Let me just share the screen, because they're beautiful, beautiful research charts. Here we go. I think we can see them, and I think the first one is gold, Charles.
No, now, this one says Dow Jones, but it doesn't matter.
Let me get up to our gold chart. Yeah, so this is the gold chart, and now this is your research down here.
Yeah, let me first explain what we're looking at. At the top is the price of gold, and the bottom red is the cycle that my program produces. And it's based on that things don't move at random. So it's not that anything can happen that will change the cycle. As you see, if you have a mouse, I don't know if you can have a mouse going up and down. Oh, I have a mouse.
No, that's me. Yeah, I'm doing it. Yep. So this area here.
No, if you go back for the last 10 years, you see every top and every bottom was produced by the cycle, and the last high that surprised everybody because everybody was super bullish. Where the dotted line is, it gives you the date on the left top, which says the 17th
Right
of
here.
July.
Mhm.
Yes. And as you see, is the situation's not over. There's going to be a very nice rally again in gold this year. But as you see, the cycle is still down for a while. So we're not in a hurry to buy the gold. Now, this has all kinds of economic implications. If money is going to be expensive or not expensive. Usually I don't deal with that so much because I don't so much deal with why things happen. I just want to know what happens. So there is going to be, if people want to invest in something, there is going to be a very nice rally again in gold. But as you look at my system, gold is still coming down, as you see on the top, and the cycle is still down into later this year. So it's a bit too early to start buying. Let's take a look at the next chart.
Well, so if we can just stay on this chart for a second, this dotted line is this date, is it not? And so you had called this as saying we're going to be getting to a cycle high. And I think you're going in and out of the gold at that time. I think you're doing $150 or $200. So you're doing some nice trades at that time, were you not?
Well, mostly that depends for whom. Yeah, we have a service for big hedge funds and big firms, and for big clients and some smaller individuals. So the big firms just stand aside. They don't go short. Gold is now down from that top about $400, and most of the investors is on a side track. It's emotionally very rewarding. You don't have to watch it. You don't have to trade it like crazy. And they wait till the cycle bottoms again, and then they go long again. Now, people who are more active look at our intraday service, and intraday, even we show the cycles during the day. So we can even say the next stop is at 1:15, and it goes down till 3:45, and then it goes up again. But this work is based on the people who are not big traders, but just wait to take big positions. And we help them with the system. It shows you when the top is and when the bottom is. So what else do you want to do? And if you want to go sleep well, then that's what you do. And if you like to be active, you look at another system that we publish, but this is more for the hedge funds and the big banks.
So you really you don't have to be trading all the time. You just need to be in the correct asset class. And gold, of course, is a store of wealth, and it's an interesting asset class because it has lots of implications other than just trading. But it's really remarkable. This is your cycle research on the bottom, and it's really interesting how it coincides to the actual price. So your chart is showing that we still haven't bottomed. So this would have been in July last year, and this is coming up to, this has got to be pretty close to now, I would guess. Huh? So this is time moving on your cycle. So we're going to be bottoming fairly soon, I would guess. We're going to have a nice entry point, huh?
I think there's something now. The first short-term low is, I think, April 20, but for bigger investors, it's still too early. Like I always tell your people, you can have a free entry to our system for 4 weeks and see how it works. So I prefer that people look at it and see what we write down, because usually when I make predictions, then they hear it like this, they hear it like that, to forget, and that doesn't lead to good results. So it's better to take a free subscription if they're interested and just see what we publish every time, because it's a bit too early to go on gold.
So is this a momentum? I know you've talked about the fact that sometimes you can get a price target.
Right.
So
we also target now. We had a price target of $650. That was given when we were around almost $2,100. We came as low as $16.75, so we didn't reach it yet. I think we can still risk down to $16.50 on the downside.
So at $16.50, that would make a very good entry point for someone that wants to start thinking of gold if the timing is correct. So if we can get the price target and the timing correct.
Right.
And I know you've been talking about a target of 2,500.
Yeah, the target is for the next move is 2,500.
Now,
so
this is your pardon me?
What we like to see is that the price target is hit right when the cycle bottoms. And that gives us a very high confidence to get into the trade.
Yeah, my baby boomers would love that. They're so risk averse that they really enjoy that. So this is a weekly chart. So and you've been forecasting mid 2000s for a target for that. Do you have a time frame? Is this going to happen in the next year or two, or are we looking out further out?
No, it's going to take a couple of years. It's going to be a slow up move, the next one. But you're talking almost about $1,000, and it's not going to explode, but it's going to go up slowly.
Well, $1,000 on $1,500 or $1,600, that's 40 or 50%. Oh, that's better than a 50% move in a couple of years. So that'd be a very, very good trade. That'd just be a wonderful trade.
Yeah, the problem is always when you write at the top, everybody's super bullish, the media bullish, and it's very hard for people to forget about the emotions and say, look at the chart, look at the cycle tops, I'm going out. So it's easier said than done. You really have to put the emotions aside, not listen to all the pundits that know what's going to go on, and just look at the cycles and say, everybody's super bullish, the thing goes much higher, but the cycle tops, so I have to sell.
Right, and what's nice is that you can actually see this on your cycle that you're right, because it kind of takes all the noise away. That this is, and it's a timing model, so the timing just is just right. Now, is this going to roll over, you think, for silver as well? Is this going to have the same type of a move? Because gold and silver sometimes move together, do they not?
Well, silver looks a bit better. The cycles looked a bit more positive than gold.
Oh,
yeah. So I think the easiest thing is to go long silver when a cycle bottoms.
So go both maybe. So silver and gold, when gold bottoms, silver is going to bottom as well. So it's going to be a good entry level for the precious metals.
Well, it could be that silver bottoms before gold a little bit.
Oh, even better. So would you say people should be looking at the bullion, the actual gold itself, or should they be looking at gold stocks, gold companies?
Yeah, just for people who are not big investors. I mean, who don't have a lot of knowledge and don't want to watch all the time. The easiest thing is to buy gold stocks.
Well, they get a little dividend too with their gold stocks, I would guess. So they get a pretty good boost on their value plus some dividend play.
Yeah, when the time is there, we also cycle different gold stocks because one performs than the other one. So then we tell them which gold stock to buy. Well,
I'm going to suggest that they get your research because it's very valuable. And so far as bullion, do you think people, small-time investors should have some gold and silver on their person? I mean, some personally held gold rather than shares and things? Do you think would be?
I have personal gold. I got some teeth over here where they're filled with gold, but for the rest, I don't have personal gold. I mean, it's what you're talking about is diversification, and it means is I actually don't know what I'm doing. I don't know what's going up. Maybe one thing goes up, maybe the other thing goes up. We just work with the assumption that we know what's going to happen. So we look for one or two or three asset classes, and that's where we invest in.
That works for me. I think that's an absolutely wonderful. I mean, diversification is fine, but you want to diversify within those that are in the trend and are in the cycle. Makes absolutely perfect sense for me. Let's go to the next chart, Charles. Let me just roll this down here a little bit. It's pretty sensitive. This is the volatility index. So and again, so this is the date is April 2nd. So this is very, very recent. And this would be this timeline right through here. So it looks like we're going to be starting to go up into a little more volatility.
Right. So we're buying some volatility over here. It's pretty cheap. And it also means that the market is getting risky because, as you know, as the market is getting weak, then people buy volatility. So this is actually a precursor of what could be. So the market starts to be risky because the volatility index can start moving up. Now, as you see, going back to you see 3 peaks, 4 peaks. You see every peak was actually projected by the cycles. Mm-hmm. Usually those are very nice trades with a very small investment.
Well, we have another peak coming up here. I'm not sure what the timeline is, but it looks like it's fairly soon. Is this one of your targets right here?
Yeah, I don't know, but that's it. I think that's the end of May or June or so.
So you and I talked about this before when we were talking about hedging a real estate portfolio. You would go and short some builder stocks, and of course, if the real estate industry started suffering, you'd start making money on your shorts. So that's kind of along the same line, isn't it? So if you've got a portfolio and it starts looking at turmoil, you're suggesting like
Yeah.
a hedge, are you not?
Yeah, then you know, it's much better than going short. You buy the VIX. You just need a broker, or not even every broker can do it, but it needs a calculation how much VIX you should do based on your portfolio.
So are these actual options, or would this be something like TVIX or one of the?
Yeah, well, there are all kinds of the options, and there are futures, and there are ETFs. There's all kinds of ways to play it. If you Google it, then you find all these things.
So fairly easy for like a novice to do this, just protect their portfolio, and of course maybe make some extra income on this, because it looks like it's pretty pronounced that you're going to get a pretty pronounced spike right here. It's following your. It's amazing to me how your cycle charts. It's just amazing, because you're right. These cycle. Your work is predicting what the market is going to do, and it's just pretty doggone remarkable, Charles. It's kudos to you. It's beautiful. Is there anything else that you want to talk about on this chart itself?
No, not in this chart, but I always come back to the fact that these things, markets move like on the news from next year. If you know the news from next year, then maybe a good investor. But nobody talks about the news from next year because they don't know. Even the Fed doesn't know. They look from months to months. So that's why these cycles predict what the news is going to be next year and how people are going to look at the news. So also the interpretation of the news is important. And that's why we can predict what markets do.
Well, I love your saying, I don't necessarily know why it's going to happen. I just know what's going to happen. And
Right.
it actually is more important to know what's going to happen than why.
Yeah.
If you know, it's just so great. So should we go to the next slide?
Yeah, I just want to mention, because most firms don't know what's going to happen. They all write why it's happening, but that doesn't help anybody.
Doesn't help anybody at all. Not
No.
at all. And I have been following you for years, and your advice has just been exemplary, and just you've helped me and my clients. So thank you. Now let's move to the next one. This one is a really important chart. So it's a great chart for you. Here again, this is last year. So we're talking about peaking. So you peaked really in
Well, take a look on the left side, beginning of June last year.
last year. Yeah, it looked like it right on time. It looked like it came in, and you can see your peaks. Now, do you think this was the bottom of the long-term interest rate cycle?
Yeah, definitely.
So if we figured, you thought it was like 35 or 38 years. So if we came back from 81, 82, gosh, that'd just be textbook, wouldn't it? That'd just be perfect.
I had even with knowledgeable firms, I had a problem because they knew a bull market for bonds since they were born, and they couldn't believe that the bull market would be over. And so a lot of people stayed in just because the bull market was always going on while they were in business, or even, when they were born. Now it's a problem. I mean, the interest rates can go, the long bond can go over 10, 12% again in 10 years or so. So that's a big problem. Everybody was talking about inflation for years. There's no inflation, but soon we're going to have hyperinflation just based on the cycle. Don't ask me why. I can come up with the usual stories. And that's going to bring the interest rates over 10%. It's
Wow.
a big problem if you own bonds and you bought them when you had 1.5%. What are you going to do? Because right now you have a big loss. We talked about it. I hope people that watch this went out. They're going to have a bounce soon, and they should use that bounce as a second chance to lighten up on their bonds. Now, the problem is that if you own bonds, you get your money back. If it says $1,000, in the end you get $1,000. But if you bond funds and you sell out, you never get your money back anymore. So it's a problem.
Yeah, there's no maturity on those, so it just they really keep going down. So and in Europe, of course, you're negative. Do you see 10% in Europe?
That I can't tell you because I didn't study yet, but usually, it goes in sync. Otherwise, the currency totally makes crazy movements. So usually it's the same interest rate.
Well, if you have a negative bond in Europe and it moves to 7, 8, 9, or 10%, that's going to be a significant loss.
Right.
I mean, a really significant loss.
Definitely.
So we have an opportunity coming in. So this has been, so when I talk to you, I pass this on to my clients. A lot of my clients have free and clear properties. If they have any financing, it looks like you're saying right through here, I'm going to say your cycle is showing that rates are going to come down for a time. And this might be.
That bonds. These bonds, the rates are going up until that low, but soon we're going to get a bounce.
This here.
To the right.
This.
No, right.
Here.
No, that's too far. Just after here, yeah.
I see. Okay. Yeah, that makes sense. Okay, I understand. So a really short period of time.
Yeah.
Well, then, so in this time frame, and you think that's fairly imminent then?
It's fairly imminent, but again, like I said, everybody can get the research for free for 4 weeks. Please see what is the knowledge in that financial institutions have, why they have an edge. At least see how to do it, and it's very helpful. And then for the next 4 weeks, it will be important to watch our research.
No, I understand. So if you've got a lot of my clients have bonds, Charles, because I use it for income. So it looks like they're going to have an opportunity. No one likes to take a loss, so maybe you want to minimize your loss. It doesn't look like they're going to be able to get back down to where it was, but it looks like they're going to minimize it, and maybe they should just move into a different asset class, maybe gold or silver. I think housing is probably still good for a little bit. What do you while we're on this, what do you think of the soft commodities? What do you think of oil and some of the basic materials?
Well, they had a big rally, and we watched the inflation index, and I think most of it is done at the moment. So I think the crude will not go much higher, and other commodities right now.
On this cycle?
Yeah, for the next couple of months.
What about if we looked out a year or two? It's really affecting my business because we've seen lumber go up, we've seen copper go up, we've seen aluminum go up, iron, all the basic building marks. It's really affected housing. Are we still looking a couple years out that we're still going to have this pressure from basic materials?
What do you exactly mean?
Do we see iron ore and oil looking out on a long-term basis, maybe a year or two out, still fairly strong?
Yeah, but I don't have that in my head, so I can't tell you exactly. You have to watch my research. I'm not everything ready.
I understand. I didn't mean to put you on the spot.
Yeah.
It's just, I'll tell you, lumber has gone up, has doubled here in my marketplace, and it's really affected the prices. I mean, it's and timing is so terribly important when you're investing. Your models are just wonderful. Should we go to the next model, which I think is the Dow? Are we done with this one? Is there anything else that you'd like to talk about?
No, let's take a look at the Dow and see that we get in a dangerous period.
Yep, there it is. Oh gosh, that's a scary looking chart, isn't it?
That's a bit scary chart. You see that it goes back to the year 2000, so it hits this is very long term. It's not for trading term. And you see it works pretty well. Like I told my subscribers, I think it's always going to work. If one time it doesn't work, it's possible, but you're going against the odds if you see this. So I would lighten up on the stock market because this doesn't look that great.
So they should really pay attention. You talked about this last year about the bonds. Those that paid attention saved themselves 17%, plus probably put that money into a different asset class. This looks
the problem is that you don't see why. It's same thing with the bonds. The news always comes a couple of months or half a year later. So you just have to close your eyes and say, listen, if this is what the cycle looks like, let me lighten up a little bit on stocks because the odds are against me.
Well, there's nothing wrong with taking a profit.
Well, it's something wrong because if it goes up next week and your neighbor makes a big profit, you don't feel good. So it's not so simple.
Well, but you know, if you do targets and we do some investing, you say, look, I want to make, you know, once I make 15 or 20% on it, you know, if I'm going to make 22% and take a little risk, is that extra 2 points worth me doing? And you know, when you get to be at my age, why we think, well, you know, trees don't grow to the sky. So you can't go broke taking a profit, particularly when you're looking at something that is telling you that we have turmoil coming on. So and speaking of that, if we put all these charts together, they're kind of saying we've got turmoil coming, don't they, Charles?
Yeah, I think so. Well, we have turmoil in the bond market. You don't hear much about it, but the investments all over the world in bonds are huge compared to the stocks.
Yes.
So a lot of it has been destroyed, but you don't hear anything because people think I still got 1.5% income. It's very strange. And gold is always a story when it starts moving up. And now it's quiet because everybody now forgets about gold. And that usually is when it bottoms. And this is going to be an interesting story if the cycle is correct. But that, again, this is a long-term cycle. Doesn't mean it's going to happen in a couple of days, but you're now in a very risky period.
So if we put all four of those charts together, gold being a store of value for thousands of years, so you would put money in there, and I think gold, if you can correct me, of course, gold really does really well in turmoil. It's not really an inflation hedge. It's kind of a currency hedge. It's kind of like when things get dicey, people put money in gold. Is that correct?
Well, you asked me that, and I'm as good as the next person. Like I said, I don't deal with these things. I only deal with what the cycles, the price targets, when to go in and when to go out, and when it tops and when it bottoms. And the rest I leave up, you know, to the historians.
Well, the narrative would be we've got gold going up, we've got volatility going up, we have interest rates going up, and it looks like we have the Dow going down. That's telling me that there's going to be some turmoil in the world, and you should really talk to your financial professional and prepare for that. See, if this does transpire, and it looks like it's going to, how is that going to affect my portfolio? How's that going to affect me?
Right. But, you know, your financial expert mostly watches reports, and he doesn't see what's coming. So he doesn't know what to tell you. He probably says, you know, I don't see anything coming. I wouldn't worry about it.
Well, we're in for the long term. That always bothers me when they say we're in for the long term. You know, I don't have a long term.
Yeah.
So when they say I'm in for the long term, it means I'm in for a severe loss. So I'm not interested in that. Anything else on this chart, Charles, that you want to talk about?
No, it gives you just an idea in a couple of asset classes, what's possible, what's not possible, and how things are predicting the price movements. And has nothing to do with the news or whatever is going to happen in the world.
Well, they're wonderful charts. So, and this is a fairly recent chart too, because this is a long-term chart. This is in January, and we have a cycle that's going down. And you know, a lot of my clients are very, very heavily invested in stocks. Some of them are 100% invested in stocks. And of course, you lose 30 or 40% of your net worth, you don't feel very wealthy anymore. So I think that's an important chart. Are we done with these? Anything else that you want to talk about on this chart?
No.
Okay, let me just close the screen. Well, you know, so Charles, I'm going to tell you, over the years you and I have chatted, you've always given very, very timely and good advice. We often talked about getting a free look at your research, and I know you've mentioned it a couple times. It's charlesnenner.com, charlesresearch.com.
Yeah, and then you see subscriptions, and there's a trial for 4 weeks for free, and then you at least take a look what is possible in analyzing markets, so you have an idea again what the professionals look at. Not all the professionals look at this, but you have to get an idea how to analyze markets.
Well, and I think that there's more than just a few charts on your research. I mean, yours is fairly in depth and,
Yeah.
I mean, you've sent me some of it. I always am remarkable at this. So Charles Nenner Research, they go on online, and there'll be a section there that they can get 4 weeks free
Free trial. I
research.
think it's 4 weeks. Yeah.
And then they can decide if this is something that they're
Yeah,
interested
if
in.
they make money with it, why not? And if not, that's fine. Then it's interesting to see.
Well, just getting into one of these, if they just got into gold and had a huge move in that, and conversely, if they just would have listened last October, getting out of and reducing their exposure to bonds, look how much money they would have saved in their portfolios and all that angst. That, a lot of people don't sleep well at night when they're losing money in the market. It really affects their lives, particularly my age. This is really sacred money that they're dealing with. It's awful when they start seeing, a 17% loss that's a pretty doggone significant drop.
Yeah, but the problem is you won't get it back anymore.
You can't get it back. No, that's right. Yeah, at my age, we're not going to get it back. So we have to be very, very careful.
Stocks might rally in a couple of years, but bonds that will take years and years and years until the interest rates will go that low again.
And as you said before, the bond market's 10 times the size of the stock market.
Right.
And really a long cycle. So this is something you really need to pay attention to. So you've done really well for us. We've gone out and got and put long-term financing on a lot of our free and clear properties. We picked up 30-year mortgages in the 3% range. It was just, it's like, wow, this is just amazing stuff. So we're really, really pleased with it. Well, Charles, is there anything else that you'd like to discuss? We're getting close to the end of the interview. I know you and I are on wildly different time zones, and I know I've got you up, and I appreciate the fact that we're talking to you. And I think we're about as far away as we possibly can be in the world.
Right.
And I want to thank you so very, very much for coming on with us today. I really appreciate your advice has been invaluable. I'll give you the last words if you like. Is there anything that you'd like to finish this with?
No, I said we're sitting here in Dubai, setting up a firm, and it's a great place. I advise everybody to come over here and take a look. It's really great over here. You wouldn't expect it, but it's really great. People are nice, very efficient. Everything is very, very outstanding.
So Dubai. Well, we'd love to come visit, and I think the world is finally starting to open up, and I think we're ready to go. We're here in Arizona. Of course, we've been reasonably open up. I saw, in the baseball games, I saw in Texas that they had baseball and people have been locked down, and they had like 55,000 people at the stadium. They were just like so happy that they get out and get stuff done. So as the world goes, things are going to get better, hopefully. Well, Charles, thank you.
If you don't come to Dubai, if you see the cycle low in gold, Dubai.
Okay. Thank you very much, Charles. My very, very best to you. Bye-bye now.
Bye.